And I will share the link as soon as YouTube gives it to me.
And you'll share those on share it on StockTwits, right? I'll share it too.
Yes, sir. I'm sharing it right now. But as I take care of these housekeeping things, welcome everyone. 6-month anniversary show. Can't spell anniversary. With
whoop, whoop. No, nobody's whooping in the back.
Yeah, no, woo, woo, woo. You know what? Of all the times we could have started doing these podcasts, we choose maybe the worst 6 months of the market in the last 2 years, right?
Yeah, no kidding.
But anyway, I think it's been great. And we special guest this week with us, who was one of our first people to join us, the one and only Cookie Monster. So thanks, Cookie. Thanks for being here with us. We really appreciate it.
Hey, my pleasure to be on the call again.
All right, I sent the tweet out, the stock tweet out. So I've been busy, as I've mentioned several times over the past few weeks, with live stuff going on, and I have to congratulate the Baggs family. Yay, we are now homeowners once again. We're no longer homeless, and the market's basically stuck down here where it's been since yesterday. Yesterday's massive sell-off. Looking at the NASDAQ right now, roughly up 0.2%, but nothing dramatic, but no room there. It seems like everyone's bated breath on what's going to happen. I think people are too scared to make moves or not make moves. But that's up for our committee here to discuss. Cookie, I don't want to waste any time. I want to jump right into you. I know that you've been in and out of some trades, some longs and some shorts, but I think in general, how have you been, man? It's great to talk to you.
Hey, thanks, man. Thanks for having me back. It's great to be with both of you, JDFI and Isa also. I've been very busy. I mean, I think it's been probably the busiest 6 months in a long time. It's true what people say when the markets are bearish, they're much harder to trade. It's exhausting. So yeah, I mean, on the whole, I'm enjoying it. I'm not going to lie. I think every market presents opportunities to learn as well as lose money. So I'm on the whole, I'm tired, but I think it's been a good 6 months. I mean, I wouldn't have it. I was going to say I wouldn't have it any other way, but I know some people are suffering, so maybe that's not the right expression. So,
well, I think it's hard when people and our listeners and watchers are no exception. When the market's hard, like it's hard, right? And I don't think any one of us have tried to make trading or investing easy per se. I think the way we've looked at things is try to simplify ideas and thoughts. But yeah, I mean, it's, when people are losing money, it's always tough, but hopefully, it's not been too bad. I know I haven't done a lot of trades, basically all of 2022. That was one thing I learned from 2021 was to find things I really like and invest in them and not necessarily try to gamble. I think that's what the stock market was for a little bit, was the casino, and people are witnessing that it's not just as easy as, okay, I'm going to buy something and tomorrow or next week it goes up 10, 15, 20%. So that's probably a hard reality to a lot of folks. Just
to build on that, I think, so we agree the bear markets are tough, but there are easy periods within the bear market and there are hard periods within the bear market. Like look at the last 3 days. If you trade with the trend, it's been pretty straightforward. It's been quite easy. You probably wouldn't have traded. You just go with the breakdown. But the 2 weeks prior to the breakdown were hellish. right? Which way is it going to break? Is it going to break up? Is it going to break down? That quite wide range tossed everybody around for 2 weeks, was hard, very hard to trade, but then became easy. And I think, one of the things that we've been practicing quite a bit over the last couple of months is to be a lot more selective and take those relatively easy trades when they present themselves, and then just take a backseat when the market starts consolidating again. And some of the messages that I've been sharing on StockFix over the last few days, including this morning, have been, recognize that after a big move, the market is going to go nowhere, particularly just before the Fed meeting as well. But generally speaking, after a large move, is going to go nowhere, maybe in a wide range, but generally it's not going to go very far, just like 2 weeks ago or 2-3 weeks ago. So we take the trade, we try not to overtrade during those hard periods, and then just go with the flow a little bit. And that final comment, go with the flow, sounds a little bit flippant, easy to say, but if you zoom out and see the big picture, then the hardest part is not trading, because everybody wants to trade. Everybody wants to trade all the time, and I think the hardest part is just knowing when to sit back and take your hands off the controls for a bit. So it's a good practice to become a little bit more zen and chill out a bit, I think.
And I really credit, the life change that we're having, me changing jobs, trying to move across country. That's really put a lot of things in perspective for me. I mean, I've enjoyed times with my kids, right? I've been able to do a lot of things over the last couple of weeks I've wanted to do. Well, sure, I don't want to see my portfolio suffering, but at the same time, I'm comfortable with what I own, and I'm not stressing over it. I mean, had these events happened a year ago, I probably would have been sleepless nights. It wouldn't have felt good at all. But I've been able to just kind of sit back and watch. And I think that's also helped me a little bit on my TA, being able to, sometimes you can't see the forest for the trees, I think is the saying. Nick and GP, we were talking about that previously in another one of our calls. But want to hear from you two guys too. GP, I know that you and I were really bulled up coming into 2 weeks ago. Nick was looking for some more downside, and I got to say, Nick has been marching on this move since basically January, seeing continued downside. But hey, fire away, guys. This is an open forum too.
I mean, I'm a purely technical guy. I kind of do my best to avoid the news and those kinds of things. So I kind of fall more into the category of a trend trader too. So whether the trend's up or down, I'm just kind of, the bets that I place are going to I try to put more in alignment with the direction I think the trend is in. The one thing I'll tell you that I think that I've learned the most about myself over the course of the last, I don't even know, probably the last year or so, is really is more or less taking like the A plus trades. And to go on Cookie's point, like knowing when to sit on your hands, I've definitely been one to struggle over the years with over trading and putting on too many trades versus sitting on my hands. That's where I give most of my money back is in periods where I either get overly aggressive when I should just be sitting in runners, or I'm taking trades that are less than, that aren't my setups, I think, more than anything. I look for a lot of symmetry. And so like, you kind of see me chirp about like kind of the ABCD setups. So like, and the only reason I go with those is because I think that the CD leg is going to be symmetrical to the AB leg. But if you can line those up with kind of areas of support and resistance, I think that they can be very powerful. And I'm not the best. I've definitely hammered on us going lower, but I'm not the best short-sided trader. Like if I'm short, it's day trades. like I don't have the balls nor the conviction to really sit in long-term short positions. So if I'm looking for like a leg lower, I'm more or less looking to find long entries where the CD leg completes than necessarily shorting, that CD leg down, if that makes sense to anybody. That and yeah, I don't know. I'm with you guys. Like it's been an exhausting. I think it's been a relatively exhausting market, but in hindsight, obviously it's 2020, and if zoom out, yeah, it looks pretty easy if you were just sticking with the trend. I don't think the one thing that I'll say is that I think that the minute this correction pushed past like an 8 to 12% correction was the minute that most of us kind of longer term bulls should have been like, okay, something more serious is happening here.
It's different this time.
This is different, right? And again, hindsight's 2020. So anyways, all we can do is learn and keep moving forward. But yeah, that's kind of that's kind of my schlick. I think what we're looking at here, every time we've gotten on and chirp, it's like we've seen some kind of bullish action, and it's like, okay, let's take it a step at a time and let's just build on it. And then it's like, boom, the legs get chopped out. This last kind of bounce was basically a 0.382 retracement in this most recent leg down. And in any case, like in a bull case, like if we're in a bullish run and we hold that 0.382, like that's a significant sign of strength. A 50% is relatively normal within any trend. And so vice versa, we're in more or less a downtrend, and we saw that awesome bar on whatever date that was. Looks like June 2nd. And I think that was the one that kind of got everybody excited in this most recent pop. And then it was like that kind of pushed us right into the 0.382, and then boom, the legs got chopped out. The volume accelerated on this move down, which kind of just has me thinking that like what we're about to see is kind of that real capitulation leg lower that I think I don't want to say a lot of people have been looking for, but that I think we've somewhat been looking for, expecting that we haven't really gotten, because the moves have been relatively orderly. I think it's other than that last kind of sell off in the last week. It's been kind of like a slow grind down. You get like 2 days down, a bar up, day down, bar up. I think what we're seeing right now is just probably some short covering heading into the announcement on Wednesday. And, like we say every time there's a Fed announcement, typically that first move or that first direction is kind of the false move. So I'm just kind of interested to see what happens. I'm more or less in cash. The only position that I even have on right now is the USO and the SQQQ. I'm sorry, but that's kind of where I'm sitting. When I don't, I'm sitting on my hands right now. I think that's all I can really do. I don't have a strong conviction, nor want to put money at work right before a Fed announcement, because the move can be violent in either direction, depending on what they do. And I'm not smart enough or in the know enough to say, this is what they're going to do, and this is kind of the reaction that we're going to get. So anyways,
welcome to the show, GP.
Yeah, I'm here. I'm listening. I'm trying to be just quick question, Nick. It's it's a common everywhere I look, it's the word of the year, capitulation, right? Everyone's looking for capitulation. And I think everyone's definition is quite different than what capitulation actually is.
Oh, so sure.
If you don't mind, can you expand on what you mean by capitulation or what you're looking for?
Probably closer to what it looked like you could say the kind of that 2020, how that COVID played out, where it was just straight puking down. Same thing back, like, let's say pull up a, let me see if I can pull
So
up
we just got a 10.4% move in the Qs in 3 days. Is that?
But we held the lows though. We didn't take, I mean, until Monday, we were still within that kind of that range within, like, let's say for the Qs, we were still within, you know, 285 to, let's say 310, 315. When I think of capitulation, I think capitulation triggers to me when the lows of that range get taken out. So like yesterday could be considered the start to it. Let me see if I can pull up another example. I'm trying to remember what 08 was like, because that's really the big so that's what always kind of rings true in my head, was where that last, let's see, that's kind of September through even that, let's just say November 08 to March 09 was kind of where, again, in my head, the capitulation was here February 17th through, let's see, March 2nd, those 3 bars, where it was like you had that range and then the volume really accelerated on that move down, but then we saw that big old weekly engulfing bar. So I don't know.
Right here, Nick.
Yeah, let's see where.
That's September.
Sorry, I was looking at my own chart. Scroll to the right just a little bit. Oh, I have the spiders up. I'm not looking at the Qs. Sorry.
Thanks for that explanation, Nick.
Yeah, I want to see the lows get taken out to really define like capitulation. And I think that if you look, again, kind of everyone's kind of TA is a little bit different. A lot of people like to think in these bear markets, we see 3 waves down. And so that would be, I guess you could kind of say capitulation, or that 3rd wave down is what I'm kind of looking to see. But yeah, I wouldn't consider capitulation until the low gets taken out. I don't know. That's, I guess, probably the best definition I could give you.
No, everyone got their own thing looking for.
I would have agreed with you. Or I did agree with you back in, let's say, was that early January, February, where that definitely looked like capitulation to me. When we took out, let's see, on the daily, on 119, 118, when we started that leg down and we just saw those wide range bars, and then we saw that huge gap down, we puked, and then we rallied hard. Like that looked a lot like capitulation to me too. But again, we took out the range lows when that started. So like we took out on the Qs, we took out the 380. At the time, we were sitting in a range between 380 and 400. That 380 low got taken out. And so we saw that puking lower. That's what it kind of feels like to me in terms of capitulation.
Okay.
Can I jump in?
Yeah.
Of course.
Just a comment. I mean, the way I understand the points about capitulation, and I think your reference to March 2020 is probably a really good one, because I think if you remember the feeling during COVID, that the drop that we had there was different to what we've seen over the last 6 months, where remember we had like overnight gaps. We had like 5% down in pre-market, and then there'd be that circuit breaker, and then it would jump, it would reverse back up 4%, and then it would be end the day down 5%. It was hell, right? And it just doesn't feel like that. And I think I don't think that's necessary. And the point I want to make here, I think this whole move down has been very different to what we've seen in the past. And you can see that when you look at the VIX. if you look at the VIX during March 2020, for example, and there you see a true capitulation. Well, again, like you said, we could define it differently, but you see a massive spikes higher in the VIX. Whereas this time, if you look at, and leave it with the weekly time frame, for example, what you see this time are waves of VIX going up and down and up and down, and it's very controlled. And it's very different to what we had in March 2020. If you look at March 2020, it was just like straight there, F up, and then it came down over time. But this time around, you're seeing these waves which last about a month each time, 3-4 weeks. And you're seeing these waves up, waves down, and each wave up and each wave down is giving us lower highs and lower lows in the market. And so my point here is that, well, there's two things. One is, where are we going? And which is more important than how are we getting there? But how we get there, I think, is quite different to what we've seen in the past. And I think maybe it is the Fed that's behind it, or somebody behind it, and whether it's through the VIX or whether it's through other mechanisms. But this descent has been quite controlled, and it hasn't been erratic. It's been quite regular, and you can see through the moving averages. And I think once you start thinking about it, where are we going and how are we going to get there? When you start thinking, dividing the question into those two parts, this could go on a long time. That's what I want to try and say, is that there's no we're going to get to, and we're going to get somewhere and then we're going to spike higher and the market's going to sail off into the sunset. The way I see it now is a very, very regular and very managed breakdown. And just like the move up lasted 10 years, I'm not suggesting that the move down is going to last 10 years, but it could certainly last a little bit longer than I think many people are considering.
Yeah.
Yeah.
And so I marked on the chart there the 2018 where the Fed started raising rates, right? And it looks even dramatically different than what the VIX and what the market's doing now, right? If we look at COVID here and we look at that 2018 sell-off, quite controlled, just completely different. You would think that
you could draw a curve underneath those lows. I mean, it's remarkable how controlled it is. You can I mean, just looking at it, you can put a nice little curve underneath all of those lows, and you'll say, "Holy fuck! Why didn't I see that before?" Well, we saw it we saw a couple of months ago, but it's
I think that's the part, right?
That's not random. That's not random.
I think that's the part with the VIX, right? The VIX, everyone saw this coming, so to speak, and they've been hedged for a really long time. So it's impossible. So like 2020, the spike happens because it's the unexpected, right? No one saw what's coming, that 80, 90. This was kind of forecasted. The Fed told you in November. So the hedging started back in November. And basically the market is now pushing up every time the hedges are starting to unwind. So that's when you see the VIX slightly come down. That's why it's been so controlled, but people are still very nervous. This is just my thoughts. I'm not saying it's truth or whatnot, but people have been hedged since November as the free money Fed has told you that they're not going to be free money. So you can't get these violent move downs. Like, yeah, we got 10% down, straight down in 3 days, but it was right to the bottom of the range. It wasn't breaking of ranges. It wasn't this unexpected move down. Everyone expected on Friday the CPI data to be bad and the markets are going to go down. So what did it do? The data was bad and the markets went down. So everything that's been forecasted is happening, so that people have been hedged. So I think personally what you're seeing is on these moves up it's the unwinding of the volatility. So that you can't, if you say bought hedge on when was it, when the Qs hit lows on May 20th, you're right back down to the May 20th kind of lows. You're not going to, buy more hedges here, right? Until it pushes back up. So that's been the volatility conversation for me. And I think volatility stays elevated for quite some time as we push through this, but it's going to be, we're going to need at some point in time to get that. I think what people are worried about here, which is the 50-60% move down in the indices, you're going to need volatility to come off pretty hard, where people are kind of say caught off guard, right? in terms of, oh, well, the markets are going much higher, and then boom, it reverses the next day or something like that. And that's where you start to see those big spikes.
Maybe it'll be a little bit different. I mean, again, we can just speculate, right?
Yeah, just my thoughts.
My guess there would be that because this has dragged on for quite a while now, you're seeing people slowly buying in what they think are good areas to re-enter the market, and then they leave again. They enter and they leave, and they enter and they leave, and so you know, and it goes back to what I was trying to suggest earlier, which is I'm not sure whether we will see that capitulation bottom, just a grind down, and and it's going to wear people out.
Just like we grind it up, we can grind down, right? That's the theory that you're putting out there. Yeah,
exactly like that. And the reason why I'm throwing that out there is not necessarily because I know what's going to happen, but just to throw out there as a realistic possibility, so that we don't expect that something that might not come, or if it does come, then that's going to be the end of it. I don't know. I'm just no, that's it. I mean, I don't really know for sure, obviously, but I'm just based on what's happened in the last 6 months, it tells me that, well, this is a little bit different. And it's a lot more managed and controlled than before. It's not just pure hedging. I think the VIX is being used as a tool to control the market, as opposed to a primary tool to hedge. I think you can control the market using VIX options, and I think that's what we're seeing. Just because you see it in the VIX, I mean, you see it just.
You're also not seeing the put flows, at least from what I'm looking at, the put flows that you're expecting to see in these type of moments, because all I'm seeing is call sellers, right? So if you're looking at call versus put volumes, they tend to be typically high, but if you're looking at what's going on behind the scenes, they're being sold. It gets to a resistance and they come out and sell hundreds of thousands of dollars of or millions of dollars of resistance calls, right? Basically, dealer positioning has to change at that point in time. So I see a lot of the flow dictating the price, which is something we haven't seen in a long time, right?
Right.
So I mean, just from the dot-com crash through the great financial crisis, if you bought in at the top of the dot-com, it took you 4,781 days to break even. That's quite astonishing, just to think about it that way, right? Like that's a long time.
Yeah, and that's I think I shared the Amazon chart last night, Nick.
Yeah, I like that.
So that's, are you ready to hold for 13 years? That was the question back in May of last year, right? So like when you look at some of the leaders, like the FANG leaders, Amazon and so forth and so on, I think we've talked about this, is they probably experienced peak growth in 2020, right? So growth usually peaks before price does. And so are you ready to be, I'm sure at some point in time in the next 5 to 10 years, Amazon will start introducing a dividend, right? That's what's going to happen, because it's gone sideways for so many years, or grind up and down for so many years. If you look at Microsoft between 2000 and 2014, best of breed in 2000. What did it do for 13, 14 years?
Right. Or maybe you're missing innovation as part of that equation, right? I mean, Microsoft probably didn't do anything for 13 years, and that's why also one of the reasons why it went nowhere. But whether it's the Facebooks or the Googles, I mean, they've been innovating for years, right? And maybe we're at the end of that innovation cycle. And I don't want to sound like Cathy Wood here, right? But I think she is right in part in that there are lots of new technologies and innovations that are going to come online, which hopefully will offset any possibility that we see in the market going nowhere for 15 years.
To talk about, to go back to the kind of capitulation talk, and how we talk, or what you mentioned about 2020 and that COVID sell-off. I think that the way that they're going to get that fear into people is as we come, if we start to really leg lower here, as soon as the SPYs hit 340, 350, every single person's going to come out and say that we're going to COVID lows. And ultimately, that's kind of where the magnet, I think, is. I think the magnet, the price magnet is kind of that February 20, that March, those March highs, the March 2020 highs. The closer we get to that, I think the more fear that we're going to really start to see, in just kind of my opinion. And confluence wise, Bags, if you draw some fibs from basically that 2012, 2013 breakout all the way up to like the all-time highs, that it's about a 50% retracement in that whole trend right there. And so I think there's a lot of confluence in the area. And to your point, I'm kind of with you in terms of Kathy Wood too. It's like, dude, we're at this major intersection of health, science, technology. Like, we're seeing headlines about like cancer curing drugs. I mean, I agree. I think that if anything, I think it's going to be the drugs, the IBB, like, and I also think the energy sector too. I think those are the two areas that are really going to shine and kind of offset, to your point, like the growth or the overgrowth there and kind of tech and the FANG names. But no, just my 2 cents.
I think cycles are becoming quicker and shorter because they're becoming quicker, from, just the innovation in everything that's happening as far as technology to even trading, right? Like, I mean, these moves would typically take longer to sort of play out.
Yeah.
In a lot of cases. So I think all the technology and all the innovation that's happened is not just creating quicker business cycles, but also financial cycles, whether that's, bubbles to recessions to what have you. I think that's one thing that has greatly accelerated is just the cycles of all these different things that incorporate markets are happening.
For sure. It's just
so like what you'll also, like, if you're drawing fibs on the NASDAQ composite, you gotta talk about what a 40-year cycle of kind of free money, Fed policy kind of started. It started around the mid 80s, right, when the last inflation kind of hit. So if you're drawing fibs from the 1987 crash to the .com highs to the financial crisis lows, we also hit a major extension. It's 261.8 on that extension, and we hovered there for, I think, 3 or 4 quarters above it, and then we just broke below it. So you're also getting some kind of technical corrections here, and where the retrace kind of ends is probably around, if there's a further correction, you can probably see NASDAQ at 5.5, maybe 6,000, right? Like, if this is the goal of what the Fed wants to do, because they got to tame inflation, they're kind of painted into a corner, then that's what I'd be watching for. I think what I was talking about a few months ago is when you break a yearly pivot low and you don't immediately reclaim it, like we're not reclaiming it here, we're back below it. The downside can be pretty nasty. Like, you'll look at Netflix, look at Facebook, like individual stocks, when they broke their yearly pivot lows, game over. Right? Netflix is down, what, 80%? Facebook is down 60% or whatever it is. It's something to keep in mind, because pivots are what I use for a lot of trading. So if you're not holding major year pivots, then you got to be expecting further downside. So I hope we reclaim that pivot, that 297.45 on the Qs. If we do, then I think this changes, but so far we've been operating kind of at or below that for months now.
All right, let's Cookie. Any last thoughts on the macro perspective?
Hey, look, I'm happy to share some targets if you're interested.
Yeah,
sure.
I'm looking for about 220 in the Qs and 290 to 300 in the S&P, or 2,900 to 3,000 in the AS.
So that's another 20% in the Qs, roughly.
Basically, I'm with you. So basically, where the 2020 highs, basically
20% across the board.
Right, but let me explain why, though. Let me explain. I mean, I've got some charts that support that, and I think you can see quite simply.
Would you like to share them, or do you want me to keep the spider?
I don't need to, but I might need you to do something for me, though.
Sure.
When I'm trading trends, I'm using the moving averages, as you all know, right? And normally in a bullish trend, you'll see higher highs on the weekly. You'll see higher lows on successive candles on whatever time frame, right? So you'll normally see, if it's on the daily chart, you'll see higher lows each day in that bullish trend. I mean, that's typically what will happen. And in a weekly chart, in an uptrend, you'll see the same thing. And in a bearish trend, you'll see lower weekly highs in that bearish trend. And those give us clues to whether, how long that bearish trend is going to last, or how, is it getting weaker, is it getting stronger? And the point I want to make here is, normally when you see a lower, let me say correctly. Right? So if you think about a bullish trend, when you first see a lower high, a lower low on an adjacent candle, on a new candle, typically price will go to the 9MA at some point, whether it's the next candle or two candles later, it will typically go to the 9MA on whatever time frame. So imagine you have an hourly uptrend, an hourly bullish trend, right? If you make a lower low on a candle, you will typically go to the 9MA on the hourly chart. Now, I can't do this on investing.com, but you use TradingView. So why don't you just pull up the yearly chart if you can? Can you pull up yearly? You can. So 1 year bars, right?
Yep, I got you.
So let's see if we can get, excellent, perfect. Now, if you put the Qs up, for example, let's put the Qs up first because it's simpler, right? Put the Q up first. The Qs, where you go? Let's just pick that. Right, so the Qs put in a lower yearly bar for the first time in 11 years. Right, it's very simple to see, very, very clear to see, and it's a very simple chart. Now, if you look at that, where does the chart find support? Now, as I mentioned earlier, if you're trading trends and you're using the moving averages as a guide, then it's typically going to go to the 9 yearly moving average. And we could talk about the weekly charts and the monthly charts, but this is just very top line, right? So where's the 9 yearly moving average on the Qs? It's about 230, 220. And if you look at what's happened since 2009, it's always found support at that 9MA. Right. So given that we've made a lower yearly low, then it's likely that we will continue and find the 9MA on that yearly chart. And it gives you a target which is very close to what we mentioned earlier, which is about that 230 level. Now, that came out on the yearly chart. I want to just say hello to Ray, who's on my site, who put up the yearly chart and mentioned that. I already had 220 to 230 as a target anyway, and I think you guys did as well, as a potential target. And if you do the same for S&P, if you put up S&P or SPY, yeah, and you can see, well, there you go. What have you got there? Currently, the 9 is 314, right? So there you've got about that you've got that 300 area, and you can see again, if you go back to 2000 whatever, it's generally found support there, except for things that have lasted a little bit longer, right? So let me just add in one more comment here. So when I'm thinking about how, where are we going or how far are we going, up or down, I'll say, well, follow the trend until it changes. So it's still a yearly uptrend. No, and it's you could say it's a bearish engulfing candle on the yearly chart, and it's pretty nasty. But what that would lead me is, a priori, the first place where it's likely to go is the 9 yearly moving average, and then we'll see where it goes from there. So as far as downside targets are concerned, I'll take them step by step. So my first one would be, well, I'm looking for 220 on the Qs. I'm looking for this 300 area on the S&P, and then should we breach those, then probably we'll end up going to the 20 MA on the yearly chart, right? And top line, like really 10,000 meters up, that would be how I would describe where I think we're going to go in 2 stages, right? And you can break that down. You can look at the monthly charts and the weekly charts. And so far since January, the trends have respected the moving averages incredibly well. So where we turned over a week ago is because we rejected the 9MA on the Qs, on NQ, on ES, on everything, right? So again, it goes back to what I was saying at the beginning of the call, which is this is not panic. This is just very organized. And I think, using simple tools like moving averages, for example, you can spot those. So we were ready for it. And it's a shame that the markets are getting weaker, but I think let it play out. I'm not in any rush to start buying longs and buying. I mean, I think there's a long way. That's if the Qs lose another 20%, then I think Apple could lose another 25%. We could be buying Apple below 100 quite easily. I think I've got even a lower target for that. Tesla 500's easy, maybe even lower than that, and the rest of them too.
So that's where I wanted to go next after we got off of the bigger picture thing is where is there safety other than cash? Is there safety other than cash? Do you try to buy lower? And this is not financial advice, but would you try to buy lower and maybe risk missing a reversal? How do each of you look at that?
Shall I start very quickly?
Sure.
I think, the way I've operated for the last few years is don't look for outliers, don't cherry pick, right? So if in a bull market, go with whatever's easy. Don't look for things which are bearish. And in a bearish market, don't try and find those 1 or 2 things that might be bullish. Why would you waste that effort? For me, I think, one of the reasons why the market is tiring for some people is because they're trying to find those 1 or 2 nuggets in a pile of shit, when just embrace the shit. I mean, if that's going to give you the easy money, then just go with that, right? And so if the market is bearish, then go with a bearish ETF, for example, right? If you want to make your life easy, you don't want to pick stocks and stuff. If the market is bullish, go with a bullish ETF, pick some others on the side because everything will go up. So basically what I'm saying is just go with whatever the market is giving you rather than trying to find outliers and make your life difficult. Because you're never sure how long it's going to remain an outlier. Okay, it's strong today, but maybe it fucks up tomorrow. I mean, just go with whatever 99% of the market is doing. And for me, that's made my life a lot easier. And it's certainly a lot more, less effort. It's just as profitable, if not better, more profitable. And I wouldn't be out of the market. I would be in the market, but in bearish positions, and hold some cash. That's what I would do. I wouldn't, try and find things which are going against the tide. So, yeah.
I think it's interesting that the NASDAQ has broken the yearly pivot lows, but the SPY hasn't, even though it's a terrible looking yearly candle. Looking back at the NASDAQ history, it's hard to compare this to any analog that you can come up with, because even in the .com crisis where we got smoked on valuations, we never broke the yearly pivot. It wasn't until the following year you broke the yearly pivot. So to me, it's a bit more unprecedented on how fast and furious the move has been down. From a hedging perspective, get a job.
That or short-term trading. I mean,
yeah, short-term trading is the way to go. You can also do call calendars, right? If you're thinking that in a couple of years or a year or two this is going to be done, when we get to resistance points, there's many ways to handle this. Outside of if you're a long-term investor, you would have had to liquidate at the very close to the top or on the first flip down to be able to kind of weather the storm here. But what you can do is generate income with some of your money to create capital that you can use to invest. I think, Cookie, you've talked about that before as well. I think you just got to embrace the pain for if you want to be a long-term investor. There's ups and downs in cycles in terms of what's going on. If you don't want to do it, sell it. But people are struggling with I've been having conversations with people. It's like, I've been holding for years and now I got to take a tax hit, and at like 50% lower. People are struggling with that. So there's a mental block that goes along with that too, because people want to be long-term investors, not trade the markets.
Mhm.
I've never been a big believer of doing anything strategy based on what the tax man needs. If you're having to pay taxes, you're doing it right, you're profitable. Just my 2 cents.
Yeah, I understand. And I think the other part of that other side of that trade is, well, now as soon as you pay taxes, your 100% gains go to 60% gains, right? Or whatever it is.
Yeah.
So people just struggle with it, but they'll happily hold it down to 0% gains on the stock.
Right.
So it's that mental block, but it's hard. Sometimes you got to be ruthless with investing if you want to be.
All right, we got a couple questions from the crowd based on China, K-Web, Baba, Neo. I haven't touched any of these in almost a year now. They've been great shorts, but I haven't taken really many trades in anything China related. Your guys's perspective on at all China?
Couldn't tell you.
It looks like accumulation on the larger time frames, but it is solely dependent on their policies and stuff. Man, they take ruthless to a whole nother level. I don't think it's a short-term trade. There's a lot of technical damage in all the names China related. So you have to have a long-term perspective on where you think it's going if you want to be in this trade, because it's going to be whippy. It's going to be nonsense for a while before things start to repair themselves, right? You're well below major moving averages across the board. But what you'll see is Baba as one is trying to reclaim the weekly 21.
Yep.
Right. And so those are all steps in the right direction, but you need to see the continuation.
Yeah, and coming back to K-Web, I mean, K-Web obviously has a big component of Baba, but you do want to see it hold that 9, but at the same time, basically almost it closed above the 21, but it failed and it's pushing resistance there now. It's just hard for me to have conviction with the China names right now. And globally, I mean, if we're looking at 20% down on the Qs and the SPY, do you think that that's not going to negatively impact Chinese names? I don't know. I think that's the question I would ask and I would want to sort through. But just looking at the chart, I mean, I think it's constructive, but it's still got a lot of work to
go. Could you zoom out on this chart? Maybe zoom out just 10 years again, just go all the way back, right? That's enough, right? The comment I would make on here is, if you look at the recent move over the last 3 months or last 2 months, which look like perceived strength, how does this compare to similar moves in the past, going across the chart to 2014? And what you see is this move that you're seeing is identical to other consolidations, let me say, going back to 2014. In other words, I think, I agree with what JP is saying, is that it's not showing anything special yet. If you look at where it's come down from 103 down to 25, and now what it's putting in is a similar move to what it did in 2014 to 2016. In other words, these corrective waves in still what is a bearish trend. There, I mean, if you look at 2014 to 2016, it did that for 3 years before it finally went higher. And one of the points that I make to like the guys that I work with each day is, don't worry about finding a bottom. Don't worry about trying to find the bottom in the market or in a stock, because even if you did, would you be prepared to babysit it for 3 months before it actually started turning up? Because let's not forget, just because you nail a bottom, it doesn't mean it's going to go back to anywhere near all-time highs anytime soon. It could go sideways for months. And when Baba first broke down a year ago, 18 months ago, however long ago it was, I remember saying that once it loses, I don't know, was it 260, 250, or whatever the number happens to be, or 210 or something? I remember saying, if you buy it, it could still go sideways for 6 months. I mean, actually, it did worse than that. It went sideways for a few months, and then it just continued to tank. And so, so to the guys who are asking the question about K-Web and Baba and even Neo, which has done the same thing. I mean, it's shown recent strength, but that's really only it's just bounced to a downtrend line in a bearish trend. Right? I posted on StockTwits a couple of days ago, so I remember the chart well. So just be careful. I mean, what you're seeing are just retracements of the breakdowns, but you're not seeing reversals. And I think it's very important to understand the difference between the two. If you want to look for, if you want to say something as a reversal, then you'll see it in the trend. You'll see things as you're saying, maybe, for me, it's worth waiting 3 months for K-Web to get back up to see the 9 MA above the 20 MA, for example, right? Or the 9 above the 50 or whatever the MAs you have there. Let it do that and then buy it, because the opportunity cost of sitting on something for 4 months while it goes nowhere in a market which is risky and possibly prone to further breakdowns is just not worth it. Buy it when it comes out of that. Buy it when it comes out of that period, and the trend shows you that it's actually showing some strength. That's what I would do, and for all of those names and everything else in general.
And just to add to that point, I mean, sure, there were some instances like that you had those crossovers, right? But you had these instances too, where you were ready to cross over and you failed before finally, this was COVID, but you had these instances where it faked you out and sold right at resistance.
Right. So let's take a look at those MA. So what you have here, you have a falling, almost vertical 50 MA. That's the golden one, I guess. Right?
Yep, you're right.
So that's falling. And if you look at the periods that you just highlighted, that MA is almost flat. So there was a better chance during 2019 to see a reversal than there is now. At least the 50 MA was flat then. And you're going to get a flat 50 MA preceding an uptrend. It's not going to go from vertically down to vertically up. And if you look at the period in 2014, it's the same thing. So again, these things will take time to heal. They could take years to heal. They could. I mean, going back to JP's point earlier, I mean, hopefully they don't. But if they heal within 3 months, fantastic. But at least you didn't jump. You didn't jump in with both feet. And then you can't sleep at night because it goes up and down 5%. It gaps 3% up and it gaps 4% down. I mean, it's nowhere to live. I mean, this is one of the things I say to the guys. It's always like, let's not make it harder than it need be. It's already as stressful as it is. So don't, if you can avoid taking decisions that keep you up at night and have you looking at your phone in the middle of the night because you're not sure about if China's going to gap up or down.
Right.
You don't need that. You really don't need it. F that. Just wait.
We've probably got about 10 more minutes, guys. One more question from Randy. Randy's our loyal. He's here on every show. Why are utilities getting crushed with nat gas coming down and rates going up? Which wins out? Randy, I have no idea. I can't. I can give you a good answer on that.
I can give you a good answer.
Go for it.
The market. We're in a bear market. Sorry. I don't mean that facetiously, but ultimately, a lot of these things are parabolic, man. Like nat gas and oil and all these things. These are like I've been saying it for a few months now, so it seems like it's repetitive, but they're all pushing towards blow off tops, right? And the blow off top can go for a while, but they're all parabolic. Like I know people are like, oh, energy is cheap. But dude, we just had a almost 500 or 600% move in energy in 2 years, right? It's got to come down at some point. The question is when it comes down, when it's going to break. So XLU, I think, had a massive move too, and then it was just giving it back. So it feels like it's part of the trap. right? To get everyone kind of bullish on one and then bring it all down one by one. And so what I actually like is that we are getting more broad-based sell-offs in this conversation. It's not just tech all the time. It was energy yesterday. I think they'll let us down. Metals let us down. XLU was not too far behind. XBI has been a dog for God knows how long, ever since the Hillary deplorables comment in 2015. Even though it's had its gyrations, it doesn't do great as soon as it gets any kind of negative news. So I think it's just people de-risking, right? That's the answer for me. Is that is that kind of conversation, and anyone else can add.
It really looks like the blow off in the XLE was been kind of all year, really. I mean, we had like 1, 2, 3, 4, basically 5 months of straight vertical bars right into all-time highs. Even if it doesn't completely roll over, I think we talked about this, GP, like even if it doesn't completely roll over, it's still, and it let's just say does continue higher, it needs time to rest.
Yeah, and we talked about it around like 82, right? Is like,
yeah,
we have room to about 91, 92 on the next kind of leg, and that's kind of where we hit, and we're reversing. I personally think we continue to kind of push towards that 92, 93 level into the end of the month, end of the quarter, and then you'll see a bigger kind of move down in the energy space as people start to reposition or start to get worried more about the markets. But we're going to try to push back up because it's still pretty strong, relatively speaking. But like, should we, so like, I think
getting your selection from Audible, resuming cry like a
so like I've talked about this a few times on our calls, Bags, but this zone, this 260 to 270 zone is kind of the last like volume support area. So like I'm watching, and I personally think if we do break this zone, it's a much bigger move down, which is why I've been wanting it to hold, but the market doesn't give two shits about what I think. And so like that's been my concern, because it was kind of parabolic on the Qs, and there isn't a lot of volume support to kind of come in, and I hate to say it, if it does break that area, I think we go back and test the original breakout.
Grandpappy Bags, one of his best advice that he gave me: wish in one hand and shit in the other and see which one fills up first.
I don't even know what to say to that.
There you go. That's what our wishes can do, and our hopes and dreams.
But so like I know, Cookie, you have your downside targets around 220. I've been looking at these charts and stuff like that. I honestly think it goes lower, right? Like that 20 year moving average is what I was looking at. 21-year moving average is what I was looking at.
Mm-hmm.
Right, like, and it could be in two stages, but I think that's ultimately where we find the bottom if we can't hold this area.
Right. I mean, as I've always said, the way I trade trends is, even like, for example, even with the energy sector here, like with XLE, my reply to this would be ride it for as long as it lasts, right? If you have a bullish trend, ride it for as long as it continues to show you a bullish trend. And it's the same with the bearish trend. So what I do is I have two basic rules as when it comes to trend trading. Number one is don't follow the trend for as long as it goes, which is what everybody says, right? So if it's a bearish trend, then let it go, but always look for potential areas of reversal. And for me, those potential areas of reversal are always given by weekly and monthly charts, right? So you tend to find in the past, that it's a monthly moving average or a weekly moving average or weekly monthly support that tends to be the ones that derail a trend at some point. So whether it's 220, whether it's 290 in the S&P, or whether it's something else in the XLE sector, mark up those weekly and monthly pivots. And then what you will find is as the moving averages get closer to those monthly levels, you will see turbulence, resistance, and either those moving averages cut through that pivot so the trend breaks out, or it doesn't. Now, the way I use those moving averages is a little bit different. So I actually use the moving averages to denote breakouts and breakdowns. So when a moving average crosses a pivot, then I say the trend has broken out. And there's a much more reliable guide to a breakout and a breakdown as well. So going back to the 220s in the Qs, what I'll be looking for is for the trend to find support at 220, meaning the moving averages start leveling out at that area at 220, and that will give me some sort of a sign that, yes, this is going to be the end of it. Otherwise, I'll just continue following the trend. So I have these different areas marked as potential areas of bottoms and reversals, but clearly I'll just follow the trend for as long as it goes. And I did that with the uptrend as well over the last 10 years. So let's see. I mean, I'd rather, personally, I don't want the market to die. I mean, it'd be nice if it stopped at 220. It's a good place for it to do that, right? If it continues going down, then God knows where we're going to end up. But it'll be nice if, my gut feeling is this is going to last a year. And by the middle of next year, we'll be like, yay, toasting not new all-time highs, but I think we'll certainly be looking at stability in the markets by my guess is by Q1, Q2 2023, we'll be having a different conversation. Clearly, obviously, I don't know that for sure, but that's what if I could choose, that's what I would like.
So just looking at the Qs on the monthly here,
Mhm.
in the past 12 years, price is only coming to contact with the 50 monthly moving average 1, 2, 3. This is the fourth time.
Mhm.
I'm not saying it is or it isn't different. I'm just making an observation.
Yeah,
Well,
and those moving averages to me represent a free money market, right?
Yeah.
So like that's why people, to me, talking about these weekly, it's important. You got to see what the price action happens, but these are all moving averages built on a certain regime in the markets, right?
Yeah,
So,
no, I wasn't calling a bottom or making this a bottom. I mean, coming back to what Cookie was saying on China's, right? Like there's a difference. All these moving averages are moving up. These are rolling over. So there's real, if we're looking at the monthly chart and the moving averages, this is kind of an unprecedented event.
I can share the yearly chart that I was just talking about if you want to see it.
Go for it.
All right. You might see my background, so apologies.
Please be an awesome desktop wallpaper.
It's the same one.
Yes.
Can you see that?
I think Cookie would enjoy the desktop wallpaper just as much as the chart.
All right. This one?
Ah!
That's fantastic.
Can't take yourself too seriously.
No.
But so like this is what I've been kind of watching for the last 8 months, and that's why that yearly pivot was really kind of important. Going back to like, this is the NASDAQ composite, going back to the early 70s, there's not many times that we've broken the prior year lows, right? Like we've been, even before the free money and stuff like that. So, but like this is from the October Black Friday crash to the .com highs to the financial crisis kind of lows, this area. We hit the 261 extension and we completely reversed to the downside, right? So my thought process is if we don't hold this area, this is where we go. It's a retest of the breakout from the .com crisis. It's the 21-year moving average. It's where we found support when we have broken the prior year pivot here back in 2008, 2009. So I don't want it to go there, but the potential that could be moving, because a lot of stuff has been kind of historical in the moves, like breaking through all kinds of indicators. They're all broken, right? Like none of the indicators are moving averages are still trending up. So on a yearly basis, I can see that being an area where if shit hits the fan, this is where we end up finding support. This is what I've been eyeing. I think I've shared this chart before, but like this is the breakdown's pretty severe. Look at that bar, right? On the yearly, on the NASDAQ composite. It's just something to keep in mind. So
I like it. Thanks for sharing. It's good. It's good to see that. Yeah.
Right. And the trend, as you said, the trend is the trend. So this is my musings on what I think can potentially happen. But obviously, if you start holding, say, 237, which is the 2020 highs, then we have a different scenario holding up. But this is just where my thoughts lie.
All right, guys, I want to put a bow in it. 6 months. It's hard to believe. It's been 6 months since we've been doing these. Cookie, you've practically been with me on when I was doing the bags cast from day one. GP, Nick, thank you guys. I've had a lot of fun doing this. We're not done doing it. We thought 6 months that's a nice time to mark, and it's been a trying time in the markets for these past 6 months, but I appreciate you guys. I always thank you guys for dropping your knowledge, everything that you guys bring to the community that you're sharing stuff on, and for your friendship. So from Bags and the Bags family, thank you to all three of you.